Hi everyone. So today I am welcoming you to the second video on the evaluation of mutual funds video series. So through this series we are trying to make our viewers knowledgeable on how to select mutual funds based on different mutual fund matrices or parameters. So in the last video we discussed about the parameters beta and alpha, which primarily deals with the relation of any mutual fund to that of its benchmark. Basically it was explaining how you can select a mutual fund based upon the parameters like beta and alpha, which essentially takes into consideration of the difference between the return of the mutual fund and that of the benchmark. Now let's look into the mutual funds its own return as well as the risk profile. So how we can use these two variables to kind of arrive into a number, and how we can use this number to evaluate different mutual funds. So when we consider a mutual fund as its own, there are two major parameters that we need to look. One is risk and another one is return. So whenever your risk is higher, we usually expect a higher return. So how we can accommodate these two factors into a single parameter, which will tell about the relative return of the mutual fund with respect to its risk. So we have two matrices related to this. One is Sharpe Ratio and one is Sortino Ratio. It is a ratio of the returns that you get to that of the inherent risk it has. So now let's look into the Sharpe Ratio methodology. So in Sharpe Ratio methodology, what we do is we take the excess return of the fund with respect to the risk-free rate, and we divide it by the standard deviation of the fund. So what is standard deviation of the fund? It is nothing but the deviation of the fund's return over its mean. So a higher standard deviation means it has higher risk. So in Sortino ratio, what we are actually looking is again an excess return divided by the standard deviation of the fund, but for this standard deviation we will only consider the downside risk, that is the risk of fund going into a negative region, that is a loss making, right? So we will consider only the data points where fund is going down to calculate the Sortino ratio. So there is only one basic difference between Sharpe ratio and Sortino ratio, that is the usage of standard deviation. The usage of standard deviation for Sharpe ratio, we use the overall standard deviation, but Sortino ratio we will only use the standard deviation using the downward risk, that is the risk when the fund goes down. Now let's actually look into calculation of one of this ratio at least. So let's take the example of Sortino ratio. So let's think of two funds. One fund is, let's name it as T fund, and another fund we name it as F fund. So let's assume T fund has an return expectation or actual return it got over an annual period, or annualized return is 10%, and whereas the fund F has 15% of the return. So if you actually look at just the return, obviously mutual fund F is better. But let's look at the other parameters. So the next parameter is risk-free rate. So for the ease of all the viewers who are ordinary people, let's assume this risk-free rate as nothing but a FD rate of 1 year popularly available in India. Let's assume it as 6%. And now let's look into standard deviation, which is the downward standard deviation for Sortino ratio. So downward standard deviation of fund T is 4%, and the downward standard deviation of fund F is 12%. So now let's calculate the Sortino ratio of both the funds. So if you look at, for fund T, the Sortino ratio is coming out to be 1, and for fund F, the Sortino ratio is coming out to be 0.75. So by comparing the Sortino ratio 1 versus 0.75, we know a Sortino ratio of 1 is better. So it actually shows that fund T is better than fund F when you consider the risk adjusted return. So it's always better to go for fund T. Also now let's look into different aspects that differentiates Sortino ratio and Sharpe ratio. So who should look into Sharpe ratio? Who should look into Sortino ratio? What are the differences? So as we explain how Sortino ratio or Sharpe ratio is calculated, it is very evident that Sortino ratio actually looks into the downward risks more. So Sortino ratio is more suitable for a person who is more risk averse, or we can say Sortino ratio is more suitable for a volatile fund, which has inherently a lot of risk. Likewise, if you look at Sharpe ratio is more suitable for a less volatile or medium volatile fund, or for a risky investor who don't consider about the downward standard deviation or downfall in a short term basis. And typically, what are the good numbers for Sortino ratio or Sharpe ratio? So usually if these numbers are greater than 1, it is considered as well and good, and something less than negative actually essentially means your return that you are getting is less than that of the risk free rate, and it's not at all a good investment, right? So that's all about Sharpe ratio and Sortino ratio, and I am quite sure that you guys will be able to select mutual fund based on Sharpe ratio and Sortino ratio, and again combining up with the knowledge that you got from the earlier video of alpha and beta. Thanks.